Okay, folks, our next speaker, longtime industry veteran, and we're really glad to have him here. It's Mr. Clayton Funk. He's the managing director for Houlihan Lokey, and he will be moderating this merger and acquisition and tower industry discussion. Prior to his role with Houlihan, Clayton was a managing director at MVP Capital, an advisory firm that provides a range of services to clients in the technology, media, and telecom sector. During his career, Clayton has closed more than 175 deals. That's actually more than you, Steve. Including M&A, sale leasebacks, private debt and equity, totaling more than $2 billion in value. So he's been there. Clayton graduated cum laude with a BA in communications from Washburn University and has been honored as an alumni fellow. Please welcome Clayton Funk.
Here too?
Yep.
Coming up. All right.
Craig. Thanks. Just go and sit on these.
I'll come on either.
Perfect. Well, thanks everybody for making the afternoon panel here. And after lunch, it might be a bit of a tough spot. We'll keep it as entertaining as possible. Thank you, Craig, for the introduction, and really honored to be up here and help with the discussion panel on mergers and acquisitions. I'll allow the fellow panelists to introduce themselves before we dive in. We're going to keep this very conversational and then leave plenty of time at the end for questions. So, guys, Todd, I'll turn it over to you first.
All right, very good. Hello, everybody. I'm Todd Raleigh. I'm CEO of the StratCap Wireless Funds. I've been in the wireless industry for a little over 35 years. I helped start up a wireless company in the 80s that we took public, and then we ended up selling that company to Sprint. Then I spent about 16, 17 years at Sprint, helped head up our M&A groups, kind of the strategy, corporate development, involved in dozens and dozens of transactions over the years. Lots of little ones and some real big ones. Kind of like the Nextel deal or the Clearwire deal or ultimately a sale to SoftBank. Certainly saw a number of transactions like that, about $125 billion worth of transactions, but some of those big ones kind of add up quickly. So, over the last 5 years, Jerry Sullivan and Scott Riggs and I got together about 5 years ago. And we really were all kind of at a crossroads in our careers and looking for kind of our next investments and where we wanted to spend our time and money and energy. And we really saw kind of what was coming with 5G. I had led the 4G rollouts at Sprint during some of our early 4G period. And we saw kind of the opportunity that we thought 5G would have specifically for the digital infrastructure space. And really felt kind of on a risk-reward basis that was really maybe the best place to actually invest in. And we had all been involved in and around that space for quite a while. And so we made that move in 2018, 2019, and been growing the fund since then. So happy to be here. Look forward to the chat today.
Perfect.
I'm Josh Broder. I'm the CEO at Tilson, and I think relevant to this conversation, in our services company, we have a consultancy that helps capital evaluate transactions prior to M&A or follow-on investment. And so we probably see, ballpark 25 or 30 transactions a year. Probably 20% of those, maybe 25% of those have some vertical asset content. If they're not a tower company, they're a company that owns tower assets. And so we see some transactional volume flowing through there. And that's sort of our day job as consultants. We also have an infrastructure company that develops digital infrastructure and leases it back to clients, most notably around poles. But I would say for today's conversation, I'm happy to learn and happy to share about what we're seeing in the sort of technology due diligence flow of like really increasingly interested in complicated transactions, which are happening.
And then I'll add on to that as far as being asked to speak, and Steve, thank you for the invitation to do this as well. At Houlihan Lokey, I sit within our digital infrastructure practice. That's really a fancy way of saying towers, data centers, fiber, spectrum, and also telecom services. And within the group, I need to count how many, I think dozens of deals that we do a year in those different spaces. I've specialized in the in-building and tower space now for almost 26 years, but being able to sit where I sit with our team is being able to see the different trends in all the different areas of digital infrastructure. Because while towers is really the gold standard of what investors are looking for and buyers are seeking, all those different areas are all starting to mesh together in terms of investors, lenders, technical due diligence, and specialists being able to assist those different companies and companies looking to buy across the different sectors. So I'll be able to offer that perspective too and tie everything in with the panelists. I think just really kicking it off, and I'll start with you, Josh. What would you say is kind of the state of the industry now in terms of M&A and what are you seeing, maybe even now compared to a year ago? Just general kind of state of the state, if you will.
Sure. So a year ago things were really frothy. There was just a ton of transactional activity and valuations were sort of at nosebleed heights, which is great for everybody here out there creating assets and building companies. I would have said a year ago that can't last. And the amount of general conditions weirdness here, I couldn't have anticipated, right? There's been, this interest rate environment that we're in, and there's been some turmoil in the debt markets. And, we've seen over the past years that the sort of transactional volumes and valuations have stayed persistently high. And also, despite the fact that there's some current short-term difficulties, good quality deals are continuing to progress. What I would say is that some of the biggest deals that we participate in have struggled to find institutional debt in ways that were much looser before. And, that's even true with large blue chip companies doing really big transactions. And so interestingly, we've seen some smaller transactions continue to maintain velocities that some of the larger transactions have kind of struggled to maintain in kind of the current moment of weirdness that we're in.
Todd?
Yeah, Josh, I agree. I mean, obviously, we've seen, pretty crazy times. Kind of coming out of COVID was interesting, right? Because everybody's like, oh, what is COVID going to do? And our industry, if anything, was probably emboldened. Wireless and communications, became a bigger part of everybody's lives and, during that time frame. But then, of course, inflation and interest rates and, now some bank collapses and all this negativity. And if you look at the public markets and you look at kind of other kind of trading metrics, you've seen understandably a big drop in values. But our industry has really, I'd agree, has maintained, and I think pretty strongly. But I think it's because of kind of our underlying fundamentals, which and if you really the build out of 5G and that continued growth that's happening, we have so much more certainty than we did probably 2 or 3 years ago. If you go back 2 or 3 years. Verizon and AT&T didn't have mid-band spectrum to roll out 5G networks. And T-Mobile was in the process of acquiring Sprint and picking up all the 2.5 gigahertz spectrum. But all of that has kind of worked its way through. I think we kind of understand now from a technology perspective what's there. The AT&T and Verizon now have solved the kind of their spectrum issues, at least short term. Obviously, long term, they'll want to continue to add to that. But the model's there, and for those of you that have been in this space for a long time, this becomes kind of table stakes. I mean, it becomes the wireless wars, and whose 5G is faster, and who gets more built, and how fast do they do it. I think that kind of tailwind has really counterbalanced the kind of the negative economic environment. Because we've just got that much more certainty as you're underwriting acquisitions. And then I think, some of this new entrant and private network development has also been kind of a tailwind that, I mean, maybe some of us saw a little bit in the crystal ball, but, you know, that's really come to some reality, and you're seeing some growth there that, you know, probably a lot of us didn't underwrite, you know, earlier on. So I think those things have kind of propped our business up, and if you look out for the next 3 to 5 years, you know, I think you're going to continue to see the 5G development go, and you know, I think there's probably some follow-on that happens after that will continue to drive values.
Yeah, I think, you know, thinking back to the morning's panel, because there was some talk about M&A on that one as well with the different panelists and the things that obviously we're talking about a little bit more in depth here. Thinking back to last year's South Wireless Summit, you know, I think what you had said, Josh, I mean, it's frothy times, right?
Right.
And, you know, there was always this discussion of, okay, when is this going to end? And I know there's been a lot of talk of, well, you know, maybe this is starting to be you know, maybe we've seen the peak and maybe it's going to be downhill from here. And I know that from where we're sitting and representing sellers, specifically, let's just talk about towers, we really haven't seen that. And I know there's been a lot of talk about, okay, well, valuations are going down. And yeah, maybe there's a slight erosion around the margins on different things. But at the end of the day, if it's a good portfolio, if it's good assets, we're still seeing prices paid now that were being paid a year ago, even though interest rates are higher, cost of borrowing is more difficult. Banks are failing. Thankfully, none of them are in really telecom. But it's, you know, from where we're sitting in our industry, we're pretty well insulated. And, you know, we do see difficulties within, you know, on Houlihan Lokey, we have a global practice, and myself and my colleagues sit in our technology group. And our technology colleagues who focus on software are seeing values down 60%.
Yeah.
And I mean, that's substantial for those of you who track that stuff. And, you know, maybe we're talking, you know, while the public companies have traded off on the equities, you know, American Tower, SBA, you know, Crown, again, the private markets, we haven't seen that sort of same trading off or trading down. So we're in a great space. I know for those of you who've been in this industry a long time, it's what we're all going to, I think, end up doing when we grow up. And, you know, we're in a good spot. Obviously, we'll see what happens, but I think, you know, for all the headlines that are out there about, you know, rough economic times, et cetera, we're really not seeing it as much as we would see it in some other spots. So with the things that have changed, has anything changed in your business over the last year compared to, you know, kind of sitting here a year ago with the ups and downs in the economy? I'll kind of turn it over to you first, if that's all right.
Yeah. Well, I think, you know, I think the deal flow has settled a bit. There haven't been as many big deals, you know, to come to market. Certainly the interest rate pressures, you know, factor into all of our evaluations. But I think, you know, from our perspective, you know, the thing that we continue to watch and you know, keep an eye on is, I think some of these tailwind opportunities. You know, I think the new entrants and, you know, continued 5G growth, you know, watching the cable companies, watching Dish, you know, watching AWS, you know, those are things that, you know, continue to develop and evolve. And, you know, those are probably some of the biggest, you know, changes we've seen. You know, I'd say, I think, also because of some of the things happening in the public markets, I think that probably has affected, you know, some of the players that play in that space, whereas private markets are a little more insulated from it. So,
Yeah, I think in our business, you know, we've seen persistent development of new towers, and so, you know, there's lots of strong tower development shops that are, you know, here at the conference that are out there producing towers every day, and with the exception of a few who have sort of a build and hold strategy, most of those towers will wind up being property of a REIT in relatively short order. And so the fact that there's continued significant production of new towers in the field means that inevitably there's downstream transactions that will happen to help those towers find a home at a lower cost of capital. And so I think there's really good indicators at the top of the funnel that the M&A environment will continue to persist. I think there is, you know, some storm clouds here on the horizon that we see as some of the mid-band projects start to, you know, meet their objectives and wrap, that there will be some sort of lower new lease production in the short term. I get the sense that those kind of cyclical fluctuations, though, are kind of already priced in. In other words, like, this is not an unexpected project completion cycle. And so the thing I was really worried about was coming out of the pandemic, we had our mobility customers kind of catch their breath for a minute as mobile traffic plummeted. I mean, when in your wireless career did you ever think that there would be a slowdown in the growth of mobile traffic even for a minute? Well, there was a period there when a lot of white collars stayed home and mobile traffic stopped growing for a sec. But now that we've seen change out in the field where people have settled in different places, they're working from home, lots of city people move to the country, people who operate networks have to go back to work and adjust to those traffic pattern changes, which drives the creation of new infrastructure and continues to drive value there. So we think that's at least a persistent trend here over the next several years. I do think that the return of sort of capacity planning to the small cell market is coming and coming fast. I mean, we've been really focused on C-band coverage for a while, and now we're starting to see capacity challenges on coverage, particularly because carriers are moving more aggressively into fixed wireless access. So, in addition to wanting to get more spectrum out there for mobility, they're selling new products. And, for the first time, we've seen the basket expand a little bit, right? The wireless carriers have been very aggressive to go and try and capture some of that wireline broadband revenue. And so that drives network needs, which drives, I think, more coverage than capacity challenges. And that coverage challenge is often addressed through small cell deployment. So I'm sort of bullish here on the return to small cell volumes, probably not at the sort of 4G initial underlay kind of intensity, but certainly at levels higher than we're seeing today.
Which is more business for Tilson?
Yeah, and all of us. It'll be great.
Pivoting on to the next topic, everybody's got a different business philosophy in terms of, and we'll talk specifically about your companies, but either growing companies organically or growing companies through M&A. You touched a little bit on your companies a bit before, but would love to have you dive in a little bit each into how have you built your company? What's your philosophy been on it? How is that maybe different than your competitors are doing it? And just talk to if maybe that would change even for you too. Do you see yourself becoming less or more acquisitive, et cetera? Everybody, start with you.
Yeah, I mean, from a StratCap Wireless perspective, our investors, we've got dividend-paying investors that we have raised our equity through, and so it was important for us to really buy cash-flowing assets. So we've grown really through M&A, kind of really underwriting all the acquisitions that way. We have focused on adding development partners and continuing to try to kind of play in that development space. I think, Josh, you're alluding to partners looking for kind of a financing structure that might shift those assets over to lower cost of capital. And I think we can play that role for partners in the space. So we've continued to try to do that way. But for us, we've been very focused on kind of a M&A growth, and then even the developer space is a M&A kind of transaction. So that's been kind of our primary focus. We have been able to really spend our time and effort on kind of the smaller transactions, call it sub $10 million, $15 million transactions. They're probably as much work as doing a $30 million transaction.
Or I was about to ask, which was easier, 10 towers or Nextel?
Well, I would not want to do that one again. But yeah, no doubt. But that's kind of been our bread and butter, is kind of just hitting singles, focusing on smaller transactions, and kind of building the assets through cash flowing assets.
And what have you seen from your competitors? Has it been, because I know it's a competitive acquisition environment, as you know. Are you seeing people more interested in acquisitions, less interested in the types of assets you're pursuing?
I would say we saw, I think, a little bit of a spike last year, maybe some new entrants, some new money that seemed to had settled down, and I'd say it's kind of leveled back off. It's still a very competitive market, and I think I think every acquisition is probably a little bit like a piece of art. Everybody can look at it and see either the beauty or the warts, depending on what their perspective is, what their backgrounds are, and what they think about the growth opportunities of those assets. But from a competitive environment, it feels like it still has stayed steady, but maybe leveled off a bit.
So I just came from Vegas, so I'll give you a gambling analogy. We have a chip on both colors here. We feel like in our consultancy, the activity we see is largely sponsor-backed acquisitions, and that is the only option. Like at the end of the day, those are not platforms developing; they are sponsors acquiring and aggregating. I think even at these prices, we'll see buyers. I was talking to somebody at this conference this morning, and they mentioned that they were involved in a transaction that was about to turn at 40 times on a relatively small portfolio, and that it surprised me at the persistence of that high number there. On the sort of Tilson infrastructure side, fundamentally, we've decided to be developers. We have the opposite strategy, because we don't think we can ever buy down as our infrastructure company at Tilson is middle market PE backed. And so at that cost of capital, we don't think we can ever buy down the sort of today's market multiples at the scale we are. Our core expertise we bring to the table anyway is development. And so we're developing assets there and don't anticipate acquiring, except in our pull asset category where we think we have some differentiated ability to make hay with that asset. But in general, we think really we have a developer's focus, and we hope to enable lots and lots of M&A in our consultancy, but on our own account, we're really, really focused on developing moving forward.
And you've got a unique perspective versus StratCap, being in the services space. While you have the consultancy side, there's been a lot of activity in that space, right? In telecom services and
gosh, there's been a ton.
Yeah. We'd love your perspective and speak to that, because from where we sit, we have a very active practice in that as well, and a lot of money chasing deals, a lot of valuations. I mean, valuations have been at record highs there too, but we'd love your perspective there.
Yeah. So we see companies who have long been interested in services companies continuing to acquire and roll up and produce some really great platforms. And we're seeing lots of new money that's showing up looking to participate. And the most interesting sort of new category there are infrastructure funds. And when you think about infrastructure funds, they traditionally invest in assets that are very long-lived, that turn relatively modest but predictable low-risk returns over a very long time period. And many infrastructure funds come from other infrastructure before they got to digital infrastructure, sort of transportation or other things. And so we've seen lots of infrastructure funds show up with a digital thesis coming out of the pandemic. Some of their, imagine that you're an infrastructure fund that used to invest in tollways, and your original thesis was nothing will ever disrupt tolls. And then the pandemic happens and no one drives and tolls fall through the floor. You think, gosh, maybe that's not quite as resilient as we thought. We need to be more diverse. Digital got the bump. They're the hedge now against the traditional stuff, so we're going to have a digital thesis. And as they try and bootstrap their digital efforts, they're bumping into the dynamic we were just talking about, which is that the valuations are really high. And so they say, well, gosh, if we can't buy it at, these really high prices because we don't think we can, buy that multiple down, what will we look for? So they start to look for infrastructure adjacent like software and services. And so, the main difference between services and sort of the traditional infrastructure they buy is it appears reoccurring, but it isn't. Ultimately, as if we were talking about this morning in the keynote, sort of this labor dynamic and the leadership dynamic, the minute that you take your eye off the ball for a tenth of a second, the music can stop. Yeah. And whereas these assets, if you own a tower portfolio, you could turn out your lights, and as long as the drop box is functioning.
Not the tower lights.
Not those lights.
Not those
you could collect checks for a little while. And so, the way fundamentally hard infrastructure performs versus services is, really different. And so not to argue against myself with the services company that wants it to be valued highly, it really is a different business. And so the infrastructure funds that have shown up looking for that, I think, are a mix of parties who have carefully due diligence that and figured it out and deeply understand that difference, and are figuring out a way to wrestle it to the ground. And I think those are ones that have advisors and adjacencies within their own businesses around other industrials. And the place that I'd sort of keep an eye on would be infrastructure funds that have energy investments that have gone horizontally into the industrial sector around energy. So imagine you're an infrastructure fund that builds wind farms, and then you start investing in wind farm services companies. Like, those funds kind of know exactly what this looks like. And I sort of rate their chances of getting it right pretty high. There are others who I think don't have that experience and are trying to like just figure out how to do it, and they have like a bigger hill to climb on that side.
No, it's interesting. You mentioned on the infrastructure fund side. Got to be careful.
That's easy
Yeah.
for you.
Oh, yeah, no. Jeez. I think with my last name, I'd be careful with those things.
Say that fast
Yeah,
five times.
no kidding. I mean, we've seen this in the last few years ourselves. I mean, those, and you nailed it. I think it was even coming in pre-COVID, where, I mean, there's only so many toll bridges and airports and shipping ports and intermodals to fund. And so these infrastructure funds started getting, I believe what's it called, Core Plus.
Right.
So you would have Core, and the Core Plus became digital infrastructure. And, you know, we've even seen this recently where, you know, in the last year, even with kind of the, you know, let's say economic choppiness, we assisted an Australian infrastructure fund coming in and buying a fiber company. So we don't see that slowing down anytime soon. And, you know, I think a study that our capital markets team had done, sponsored coverage team had done, is that I think only 20% of infrastructure funds, ones who have historically invested in the larger projects, only 20% have a digital allocation so far. And so we believe that there's going to be, you know, investment professionals that leave some of those firms, having been educated on towers, fiber, data centers, go to the next firm, and then that's going to keep expanding, and that's going to keep bringing in different pools and new pools of capital.
Yeah.
That's obviously a very bullish view, and it's self-serving, and our clients love it. But at the same point, you know, there's a logic to that, and we've seen that start happening across the board. And then to your point too, Josh, I mean, you know, the fact that I think it's now Core Plus Plus, and that's where services are fitting in.
I think that's right. I mean, the sort of the middle ground on this would be software as a service around infrastructure. And so I think you've seen depressed valuations on the back of the Silicon Valley bank challenges, but like fundamentally, those cash flows are not different than they were yesterday. Yep. And the fact that those companies have temporarily, I believe really temporarily, reduced access to liquidity. And I can give you like one anecdote. I'm involved in a company that has software as a service around digital infrastructure. I'm on the board of this company, and they're with Silicon Valley Bank. And, you know, we had a tough weekend. I said, gosh, like, I wonder how this is going to go. Well, you know, over the weekend, we were able to arrange alternative liquidity from two banks that gave us just what we needed. And ultimately, we didn't need that. But the point was that the fundamentals in that software as a service business are strong. And so I think the valuation depression is actually a value acquisition opportunity for folks who are looking for, you know, infrastructure adjacent things, because the infrastructure adjacent thesis of like, look, if I can't own the mine, I want to sell the pickaxe is accurate. Mm-hmm. And so if you can find a value buy in that moment, I actually think it's a perfect opportunity for acquisition. If I ran a fund and I don't, I'd be looking there right now.
Yeah, and I think, well, using the numbers I think have been thrown out there, I mean, if people are saying towers are too expensive at 40 times, of which some people think that is, I think it's actually normal price. Then,
Depends
you know,
on the day.
But
Depends on if you're buying or selling.
buying or selling. But buying a services business in the high or especially low double-digit EBITDA multiples is in some ways a cheaper entry point to invest in digital infrastructure.
Yeah, and provided that you have confidence that management can keep the music going. If you really believe that those cash flows will be persistent, which is the underwriting decision, fundamentally, like the returns on that equity could be really favorable. But again, based on your belief on the ability to, you know, continue to do that. And the one thing that everybody in this room lives every day is just how high the change rate is in our industry. And so that requires services companies to be super adaptable, to be able to continue to deliver on, you know, big revenue plans, even when the work and customers are changing underneath their feet. Like, that's not an easy thing to do.
Looking at the time, I want to make sure to leave time for questions from the audience. So open it up if anybody has anything that they want to be able to ask. I also have a lot more questions that I can bombard these guys with. All right. I guess, and we haven't even a couple more minutes, but in terms of, I guess, what would you see for the rest of 2023 and fast forwarding to South Wireless Summit 2024? What do you think in terms of deal flow, prediction on, valuations, et cetera? And I know that we've kind of knocked that around. What does the impact of higher interest rate mean, both in terms of deals, customer spend, et cetera? But what's your forecast look like, Todd?
I think, we continue to kind of see more of the same. I think we think the pipeline's going to continue to remain strong. I think opportunities will continue to grow. One thing to kind of keep an eye on, I think Verizon just reported that they crossed the 200 million POPs mark with 5G, ultra capacity or ultra wideband coverage. Call that 2/3 of the U.S. POPs wise, but it's only about 20% of the geography. That's 80% left to go. So there's a lot of 5G development that will continue to happen. And so I think assets will continue to grow. I think we're going to continue to see, strong lease up momentum. And as you do that, that's just going to continue to reinforce a lot of valuation. So, I think we are in a really good space, talking about services versus these assets. The execution risk is pretty much lower when you have, such a strong, stable, fixed asset like this, with pretty simple operations required. The management risk doesn't have to be, as high. And so we see a lot of opportunity there. I think somebody talked a little bit about the fact that in one of the prior panels, that we're operating, at these mid-band, spectrum levels. And, having lived that, when we were at Sprint, we rolled out 1.9 gigahertz for our PCS, and then we went to 2.5. And we had to see about 1.5 times as many cell sites to create an RF grid with 2.5 that could cover what 1.9 has. And I think Neville Ray recently had said something about the difference between 2.5 and 3.5 was about another 1.5 times. So, but what that really, I think, is going to mean is that we're going to see kind of an initial wave of building out, these existing sites that are there. But there's going to be a lot of densification required, a lot of fill-in. And I think that is opportunities for a lot more new builds, small cell opportunities and creative opportunities. So I think those are the things we're likely to see coming up over the next, call it, 2 years. So we'll watch for that. And all of that, I think, lifts our boats, in this space. I think the other thing that, we'll want to continue to watch, and I'm very bullish and optimistic on, you were talking about just the capacity and the amount of data, continues to double every 2 years or whatever. But, as we built out 4G, I remember a lot of really smart guys sitting in our conference rooms saying, why are we building out this 4G? Who needs this kind of speed? If you need that, you're just going to get on your internet Wi-Fi at home. And of course, what happened, an industry literally blew up, and companies like Uber and Lyft, that didn't even exist, get created from that innovation once the networks were there. And it just prompted, think about all the things that happened with social media and Instagram and Facebook, et cetera, and all the video sharing. It will be fascinating to watch what happens and what gets enabled and what kind of innovation happens with 5G. And a lot of talk around kind of AI and self-driving cars and a lot of logistics stuff and teleeducation and telescience and healthcare plays. I think, we're sitting here today, I don't think none of us probably could imagine what's going to happen there. But as that starts to explode, that will continue to put more and more pressure on all of us to continue to increase capacity, increase coverage, and that really means increased infrastructure. So that's what I think, over the next couple of years are the things to kind of keep an eye on.
Yeah, I'd echo those comments, which sound right on point. I think on the capital side, we'll also see, the persistence of really strong capital interest in the space and, of course, lots of money on the sidelines looking for a place to land. We have seen the trend of two things pulling against that. One is that funds are struggling to close their raises in this environment. And so sort of like delayed LP funding of new funds, will delay deal flow or deal closes on the back end. And we think funds will be more discriminating and thoughtful about investing. And so despite the sort of persistent high values, we expect deeper due diligence, longer sort of exclusivity to close timeframes, probably less parties, like highly interested and focused parties, but less parties in, sort of final glide slope to an end process. And while that's going on, the market's going to change a little bit. I think we'll see a little bit of headwind in wireless around total addressable market. So if you think about like the two biggest areas of expansion in all broadband and any technology in terms of customer acquisition has been satellite through Starlink and fixed wireless access. And as challenger brands in the cities and federal funds in the country drive fiber into more homes, we will see for the first time in a long time significant first slowing of expansion and then shrinking of the total addressable market for satellite and for fixed wireless access because of the penetration of fiber and fiber at potentially very affordable prices. And so I think that that's an interesting thing to keep an eye on, which could be a bit of a drag. On the flip side, the expansion of those fiber networks lays the foundation for the next generation of wireless networks at much higher densities and lower costs, because even if the nodal costs are consistent, if the fiber cost and availability goes down to backhaul them, that'll enable new technologies. And I think to some of the points made earlier is that the worst people to ask about how you monetize a network is a bunch of network people. Like that's an application person question, right? We don't know. But we've seen it happen enough times that that as the network technology advances, then the applications that ride that network come down the pike. And I would assume that the availability of new network drives the potential for much faster wireless networks.
Perfect. Well, please help me thank Todd and Josh for being on the panel. Appreciate making it.
Thanks, Ben. Thanks, Todd.
Yeah.